Metaplanet raises $50 in zero-interest bonds to buy more Bitcoin. Tokyo-listed Metaplanet 3350.T disclosed on April 24, 2026, that it closed a $50 million zero-interest bond issuance, with the proceeds earmarked for additional Bitcoin purchases. The raise was reported by CoinDesk and confirmed in the company's Japanese-language filing on the same day. BTC traded at $77,716 at the time of the announcement, down 0.6% over the prior 24 hours, according to CoinMarketCap. The crypto fear and greed index sat at 58, a neutral reading. The mechanics of a zero-coupon bond raise zero interest, or zero-coupon bonds pay holders no ongoing interest. They are typically issued at par and repaid at par on a set maturity date, meaning the lender's entire economic return has to come from something other than yield. In Metaplanet's case, the something else is its own equity story. Buyers of the bonds are Metaplanet's largest existing shareholders and allied investment vehicles, and the filing indicates the bonds can be used toward future share subscriptions. That structure makes the $50 million function less like traditional debt and more like a pre-funded equity commitment. Metaplanet gets immediate capital for Bitcoin purchases without diluting shareholders today. And bondholders accept zero carry because they expect the implied equity path to pay off. This is the same playbook Metaplanet has used for most of its 2025-2026 Treasury build. The company has steadily issued moving strike warrants, ordinary share placements, and now zero-coupon paper, rotating through instruments as market conditions shift. Each round ends in the same place: more BTC on the balance sheet. How much Bitcoin Metaplanet already holds? Prior to this raise, Metaplanet's most recent Treasury disclosure reported holdings in the low five-digit BTC range, making it one of the largest corporate Bitcoin holders in Asia and the largest listed holder in Japan. At $77,706 per coin, $50 million translates to roughly 643 BTC before fees, execution slippage, and any staged buying program. The company has historically announced purchases in tranches shortly after capital raises. Management has been explicit that the Treasury is the business. Metaplanet shifted from a hotel operator to a Bitcoin-focused holding company in 2024 and has since treated BTC accumulation as its primary use of capital. Why zero interest works? Right now, three conditions make zero-coupon Bitcoin financing viable: a shareholder base that is willing to accept long-dated, non-yielding paper because the upside is embedded in the underlying equity. Metaplanet's share price has tracked BTC closely, and lenders who are also shareholders effectively get Bitcoin beta with no coupon drag, a market where Bitcoin is volatile enough to justify aggressive accumulation, but not so euphoric that issuance dilutes into a top. BTC at $77,716 is roughly 3.5% higher than a week ago, but still well below its 2024 highs. A legal structure in Japan that permits zero-coupon issuance to qualified investors without triggering the full prospectus process a public bond offering would require. The result is a capital structure that costs Metaplanet close to nothing in ongoing interest while letting the BTC stack compound. If Bitcoin appreciates, bondholders convert or roll into equity at a profit. If it does not, Metaplanet still owes the face amount in cash at maturity, which is the real risk. The risk inside zero-coupon BTC treasuries. The catch in any leveraged treasury strategy is the mismatch between a liability denominated in yen and an asset denominated in Bitcoin. A drawdown in BTC does not reduce the repayment obligation. Metaplanet has disclosed this risk repeatedly, and its public filings describe cash reserves and operating cash flow as secondary backstops. Investors considering exposure should note that Metaplanet's equity trades at a premium to the net asset value of its Bitcoin holdings. Part of what that premium is paying for is management's willingness to keep layering on cheap financing to grow the stack. It is also pricing in the risk that the financing cycle reverses if Bitcoin falls sharply and the company has to service maturities from asset sales.